Very good afternoon to all of you. On behalf of Auditing and Assurance Stand- Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 120th CP program organized by AASB of ICA this year. Today it would be 120th webinar, 120th CP program, and for this we are organizing this webinar on the very important topic, that is risk assessment and responses to the assessed risk. In this, we are going to tackle two very important standards, SA 315 and SA 330. In order to tackle this, we are having with us very eminent speaker from our Chartered Accountant fraternity, CA Dr. Chinnaswamy Ganeshan ji. So on behalf, thanks as well as warm welcome to sir for sparing your valuable time. Welcome to you, sir, on behalf of AASB of ICA. Before I proceed further, it is my proud privilege to share with you the brief profile of CA Dr. Chinnaswamy Ganeshan ji. CA Dr. Chinnaswamy Ganeshan ji has started his practice as a chartered accountant in 1988. He was in personal practice till 2005, and then he served as a director in Lovelock and Lewis network firm of PwC for 6 years, and as a partner in BSR and Company LLP networking firm of KPMG for 6 years in the audit practice. He handled Indian and multinational clients in automotive, auto ancillary, IT, BPOs, KPOs, telecom, industrial markets, consumer markets, pharma, healthcare, transport, logistics, shipping management, BSIR, oil and gas, plantation, banking and financial services, and insurance sector. He was the lead partner for many Indian and multinational companies and carried out audit advisory and international financial reporting. He is presently the senior partner and head of the audit of assurance of Messrs. CNGSN and Associates LLP Chartered Accountant, Chennai, a firm with 11 partners and around 120 team members. Shri Ganeshan ji specializes in financial reporting, including Ind AS, IFRS, US GAAP, company law matters, audit and taxation, and is recipient of the Jewel of the India Award for his role in the financial services and Certificate of Excellence for his contribution in the field of financial services by International Business Council. Shri Ganeshan ji has presented more than 1,250 papers at various seminars, workshops, and conferences, both in India and overseas, on these specialized subjects. He has assisted more than 80 companies and on Ind AS IFRS in India transition. He has authored a quick reference on IFRS with a model question and answer and the revised Schedule 6, Ready Reckoner, India's quick referencer and Ready Reckoner for financial statements under Schedule 3 of the Companies Act 2013. Dr. Ganeshan ji is closely associated with Institute of Chartered Accountant of India for the past 20 years and is a guest faculty of all the 5 regional councils. He was a co-opted member of Accounting Standard Board for the Financial Reporting Standards in India and India's Transition Facilitation Group. He was a co-opted member of the India's Implementation Committee of ICAI and committee involved in the implementation of IFRS in India and Auditing and Assurance Standard Board of ICAI. Dr. Ganeshan is associated with many chambers of commerce like CII, FICCI, ASSOCHAM, universities like University of Madras, Annamalai University, Loyola Institute of Business Administration, Madurai, Kamaraj University, Vivekananda College, and staff training colleges of RBI, CAG, and other banks. He is presently a co-opted member of Executive Committee of Institute of Directors, Chennai, Board of Studies of the Director of Commerce of the Shiv Nadar University, Board of Studies of Department of Commerce of University of Madras, Board of Studies of the Department of Commerce of Thyagaraja College, Madurai. Dr. Ganeshan ji is advising many boards of the Indian and multinational companies and is presently an independent director in board of directors of Railtel Corporation of India Limited, a mini Ratna public sector undertaking under the Ministry of Railways. He recently led the company to win the Excellence in the Financial Reporting and Award of the Institute of Chartered Accountant of India. Still, the list is very vast. So once again, I welcome you, sir, in this 120th CP program organized by AASB of ICA. So without wasting much more time, I request today's learned guest speaker, CA Dr. Ganeshan ji, to please deliberate on the topic. Over to you, sir.
Thank you so much, Anil ji, and also the chairman and vice chairman of the Auditing and Assurance Standard Board of SA for giving the opportunity of sharing my thoughts on these two important standards, SA 315 and SA 330. While we consider SA 315 and 330 as less important standard because it's not specifically talking about any audit evidence being collected and that audit evidence being the basis for conclusion in our audit opinion. If you see the latest audit quality review report issued by NFRA or the various show cause notices issued on practicing units and partners of practicing units on the audit quality and professional misconduct, maybe the professional negligence, when they are mentioning the major areas where they are concentrating on SA 315 and 330, because they believe that unless you assess what is the, maybe I can say that first you identify what is the areas which are forcing the challenges for misstatement or the risk of material misstatement and assessing the impact of that material misstatement, and later on how you will respond to the assessed risk by means of your nature, timing and extent of audit is what is normally being questioned in majority of the review reports issued by the regulator, for the audit regulator, as well as disciplinary cases which has been initiated by the Institute of Chartered Accountants of India and its members, the FRRB. Even the peer reviewers are asking how you have actually identified and assessed the risk of material misstatement based on your understanding of the entity, your understanding of the environment in which it is operating. And once you have identified and assessed the risk of material misstatement, which is going to impact your audit opinion per se, how you are planning your audit procedure, maybe the nature of the audit procedure, the timing of audit procedure, the extent of the audit procedure, how you have planned it to address each of the assessed risks. If these two are not available in the planning section of the audit documentation, it is always being questioned that you have not carried out the audit in accordance with the standards on auditing. Because the first and foremost is the assessment of risk of material misstatement. If I have not even thought about where the risk of material misstatement will arise, how I will be able to do an efficient and effective audit to ensure my reporting maybe a unqualified audit opinion. What is the basis for that unmodified audit opinion is what is being questioned by the regulators. So accordingly, even though we believe that 315 and 330 are less known standard, that becomes most important standard at the planning section and the execution section of an audit cycle. So with that as the preclude, let us look at the two important aspects which we are supposed to cover in this particular session, maybe for another 1 hour, 30 minutes or so, and then we will have a Q&A session for 15 minutes. What we are talking about is SA 315, risk assessment, and 330, responding to the assessed risk based on SA 315. Both are interrelated, closely connected, and accordingly, without or maybe independently considering the standards for our understanding may not be proper. That may be the reason why the WASP has specifically designed this particular session to consider the discussion on 315 and 330 for the benefit of all the members. Let us understand what is 315 is talking about. SA 315 is talking about. It's very important for us to understand this particular concept of what is on the stores. It talks about what is your knowledge and understanding of the entity. Maybe you can simply say that how you have understood the business of the entity. Based on the business of the entity, what are all the key risks which you are thought about, or what is the key business drivers, and what, if not properly controlled, will result in a material misstatement. So the understanding of the client's business is the first point considered under SA 315. But it also says maybe the entity, the business of the entity, the structure of the entity, all those things you might have considered for the purpose of designing your audit program. But sometimes the entity may be operating in a different environment. Maybe, for example, the entity may be operating in an environment where the risk of material misstatement is low because the control is very strong. And the monitoring of controls and the control activities by the management is very, very strong or very robust. In that scenario, the environment, even though the entity has been understood that may be prone for risk of material misstatement, but the risk of material misstatement has been already taken care by means of putting in mitigating controls. So understanding the environment in which it operates is also important for the purpose of our understanding. And of course, when we are talking about an entity and its environment, most important aspect is what is the control environment? What is the controls which are put in place by the entity for its operations? You know pretty well, we are looking for the internal control system to be robust. There should be a proper internal control system in existence. The existence of a system itself is not enough. It should be operating effectively throughout the year, not even at the year end. Throughout the year, the internal controls should be operating effectively. Then that gives us the comfort. A transaction which is initiated by the entity must undergo a lot of maker-checker validation, and based on maybe the authorization matrix or the control matrix which they are holding within the entity, it will be reviewed by various levels of authority, and finally it will be approved to be recorded as a transaction in the books of accounts. And because it is accounted as a transaction in the books of accounts, it will also have its impact properly in the preparation and presentation of the financial statement. So we are looking for the robust internal control system. In the absence of a robust internal control system, the reliance on the entire activity or entire way in which the process is being initiated and verified and finally becoming part of the presentation of the financial statement may not be giving comfort to the auditor and of course for the management as well. So accordingly, we are trying to see, in case internal controls are not operating, what should be my risk assessment of material misstatement, and based on that, what type of substantive audit procedures I have to carry out. Controls are not relied upon. What is the substantive audit approach which I have to do, and how I have to collect my audit evidences in accordance with SA 500, 501, 505, etc., etc. Okay, this fundamental principle of 315, understanding the entity, the environment in which it operating, what is the internal control system which is existing and operating effectively with respect to the entity. This is fundamental for us to understand 315. So, what should be our starting point to assess the risk of material misstatement in respect of by the understanding of the entity and its environment? What is the starting point? I used to say we have come across the audit. It's time immemorial. We were having the audit process, the audit technology, the audit program, the procedures have undergone a lot of changes. Manual accounting to computerized accounting to completely ERP driven. So when completely system driven is also happening. But what has not happened in the world of auditors, there is no change in three words which are critical for starting an audit. That three words is very simple. Understand the business. Unless you understand the business of the client, it is not possible for you to identify the risk of material misstatement, first of all. Because you are not able to identify the risk of material misstatement, you will not know what type of audit procedure to mitigate that risk so that your audit opinion is proper, audit opinion is correct. It is not an wrong audit opinion or incorrect audit opinion. So when we are talking about understanding the business of the client, which we are talking right from the beginning when audit has started. I normally say that this understanding of the client's business allows the auditor to at least create 10 relevant questions in respect of each and every document which he is reviewing. For example, if I am talking about an IT and IT-enabled services company, what I will normally look at is the business relating to the risk of material misstatement in that particular company. I normally look at one, what is the revenue recognition process, whether it is in accordance with the approved or recognized financial reporting framework, because revenue is the key top line. And secondly, normally the IT and IT-enabled services companies will have major cost of employment or HR cost or employee cost. So how the employee cost is properly recognized, accrued, accounted for in the financial statement to draw up a proper profit and loss. The moment I say there is a revenue related material misstatement, I also consider, is there any possibility of fraud risk involved in inflating the revenue? Because whatever you are billing in respect of IT and IT-enabled services company, there could be a possibility of you will not be able to see the product because it's intangible in nature. So accordingly, whether the revenue recognition, not only in accordance with the SA, your AS 9 or AS 7, or maybe I can even say Ind AS 115, but whether it is also addresses the controls which are existing, it addresses the possibility of removing the fraud risk according to SA 240, whether I have to consider that. And the fourth element which I normally consider, because revenue is the major area, what is the outstanding accounts receivable, whether they have been properly collected, or if it is outstanding for beyond the overdue days, whether any valuation allowance or any provision for doubtful debts, or maybe a provision for expected credit loss has to be made or not, so that the financial statements are properly presented. Okay, that is the fourth one. And at the same time, I also look at, because it's the IT and IT-enabled services, what is the technological changes which are happening? Because of the technological changes which is happening in that particular industry, whether any impairment of its assets has to be tested for, whether any accelerated amortization of the intangibles has to be considered. So very simple. The moment I understand the business, I can know what are all the areas where there could be a possible misstatement which is material. I'm not talking about small mistakes. For example, when I'm entering a purchase, maybe I will not say purchase, when I'm saying that when I'm entering in the expenditure voucher, instead of entering it to 10,000 rupees, if I'm entering it as 10,200 rupees, that is not a material misstatement. So I'm assessing the areas where there could be a possible material misstatement, risk of material misstatement. That is possible only if I understand the client's business. So that is a critical point for us to look at. When I see the macro approach to SA 315 read with SA 330, the moment I have identified the risk attached to that business, how I am going to respond to that business is the next relevant topic. Maybe when we are looking at this single slide, it talks about what should be your practical approach or a macro approach towards SA 315 and SA 330. First, let us talk about SA 315. As we have said, we are talking about understand the entity. Understand the entity, entity's environment, entity's internal control. That's the first slide which we have seen. When we are looking at the understanding the entity, we are also looking at what is the business of the entity and what is the key business drivers, what is the area susceptible for fraud risk, and what is the areas where there could be a possibility of material misstatement. So we are assessing what are the risk of material misstatement, maybe we will identify and then assess. We may perceive that there are a lot of areas which may be containing, and we will identify them as the risk of material misstatement areas, but we have to evaluate whether they will really contribute or assess as a risk of material misstatement. This identification and assessing the risk of material misstatement goes on two aspects. One, is it because of error? So when I say risk of material misstatement because of error, the way in which I enter, maybe a manual control, not an automated control. It is not a system driven. It is based on still a manual basis in which the approvals are happening. The manual intervention is more and more, there could be a possibility of human error, which may have an impact of risk of material misstatement. Fortunately, because now we are auditing in a computerized environment, the risk of error is reduced to a minimal level as far as the entry level activity. But at the same time, the risk of error goes up unless we check the application control, the information technology general control. When I say information technology general control is who is accessing the system and whether they have the authorization to access the system, who can initiate that particular process, who can approve it, and what is the layers of approval, etc., etc. So that gives one comfort that unauthorized persons will not be able to access the system, and to that extent, unauthorized mistakes may not happen. So that is one area we are looking for. And automated control says that the program which you are using, if I put a transaction, the output should be this, the result should be this. Whether that result is coming in or not, if there is an error in the program, there could be a possibility of doing it. We'll look at that particular aspect a little later. The second most dangerous element is fraud risk. Suppose if I assess there are areas which are susceptible to fraud risk. Naturally, SA 240 asks me to address those risks as well. Even though we are still trying to say that we are only watchdogs and not bloodhounds, but SA 240 gives a very specific responsibility whether the auditor has considered fraud risk in an audit of an entity, independent audit when I'm doing, whether I have considered that fraud risk as well. The reason for fraud risk is the magnitude of impact arising due to a fraud normally will be material to the financial statement. And the most important issue also relating to fraud is normally fraud will be unearthed after a particular point of time, not immediately when the fraud is happening, unless the internal control systems are very strong enough. After 3 years or 4 years, all of a sudden a fraud is unearthed, a scam is burst. And then the auditor, the management, and all the people connected with that particular entity's financial reporting process is being questioned. So the auditor should also consider fraud risk in the assessment of the risk of material mistake. Okay, I have assessed the possibility of fraud risk, which may have an impact, or the possibility of risk of material mistake due to error, because I understood the business environment and internal controls. And what is the level at which I have to see this risk of material misstatement is whether I have to see at the financial statement as a whole, or I have to see at the component level. Component level, when I'm saying fixed assets is a component, or property plant management is a component. I'm changing the words because the accounting standard is also changed the word. Or revenue is a component, or your intangible asset is a component, or maybe your employee cost is a component. So what is the level at which I have to consider or identify and assess the possibility of risk of material misstatement as per SA 315? SA 315 makes it very, very clear that you have to do at the financial statement level. You have to link it with the financial statement level and at the assertion level for each of the components of the financial statement. For example, when I'm saying financial statement level, financial statement as a whole, first part. But it goes to the next level or the next granular level, and it says you have to link the identification and assessment of the risk of material misstatement at the assertion level. The assertions is nothing but it's a jargon which we are using in audit, but nothing but what you expect from a particular component of the financial statement, or what is the promise which the management is giving when they are putting a particular number in the financial statement in respect of, maybe we will take it up, property, plant and equipment. What are all the promises which they are supposed to give? First of all, when they are recognizing as an asset, they must have the right with respect to that asset. And because they have purchased an asset, there could be a possible liability attached to that. What is the rights and obligations relating to property, plant and equipment? Maybe I have taken a loan based on the security of the property, plant, equipment. What is the obligation which I am supposed to disclose? The second is completeness. The assertion level is completeness. What is completeness? All the transactions relating to the current accounting period has been properly accounted for. That means all the property, plant and equipment which has been purchased during the period has been properly accounted for within the correct period. And if they have not been installed and they are not ready for the intended use, whether they have been properly classified as capital work in progress, right? So the next assertion is basically the completeness. Presentation and disclosure. Is it a property, plant, equipment as a capital WIP? Whether this item is also treated as an inventory if I am buying and selling the property, plant, equipment. What is the presentation and disclosure to make you to understand that? The next level is, because it's an asset, what is the value which I have to put it at the time of acquisition and subsequent measurement. Subsequent measurement, after I have purchased, I should consider depreciation. I should consider whether the assessment of estimated economic useful life is proper, whether the depreciation method applied is reasonable, whether the depreciation charge is correct or not, and whether any impairment has to be tested for. With all these things, you will be able to assess that the value at which the property, plant, equipment is shown in the profit and loss account, in the balance sheet, is properly valued. The assertion of valuation has been taken into consideration. Accuracy is another assertion or promise that all the transactions have been properly accounted for, accurately accounted for. There is no mistake, which they are talking about. So when we are looking at this type of assertions or promises which management is giving, we are trying to find out whether the risk of material misstatement is relating to presentation and disclosure, whether the risk of material misstatement is relating to valuation, whether the risk of material misstatement is relating to the rights and obligations, whether the risk of material misstatement is relating to, say, for example, completeness. Like this, we will identify what is the risk of material misstatement. Maybe completeness, you will see that there will not be any issue. But the impairment testing and depreciation and the assessment of economic useful life could be a challenge for a particular type of property, plant, equipment. In that case, the risk of material misstatement is high in respect of that particular assertion. So within the financial statement level, just 1 minute. So the risk of material misstatement at the assertion level, when we have linked it, we will know that what should be the required audit procedures to mitigate the assessed risk. See, for example, if I'm saying there is a technological change which has happened, and accordingly, whether the property, plant, and equipment has to be tested for impairment, I know pretty well what is the audit procedure I have to apply for impairment of asset for the purposes of applying my accounting standard, maybe Ind AS 36 or AS 28 as the case may be. How I have to do that? I will be giving well in advance guidance to my team at the time of planning itself. during this year, there is a technological changes and accordingly, there is a possibility of impairment, or this entity is continuously loss-making entity, whether the impairment of the assets is required based on the value in use. So when you look at the assertion level, you are disaggregating the entire activity into a very focused risk assessment, and to that extent, at the end of the period, when you are trying to design, trying to implement responses, how it is responses, nothing but the nature, timing, and extent of audit procedure you wanted to do. For example, when I am saying there is a possibility of impairment because of technological changes, I may ask for a valuation report, or maybe I will ask them to assess whether the management has carried out an impairment test on its own, and what are all the assumptions used in the impairment testing, whether those assumptions are supported by proper evidences, and it is benchmarked with what the industry is doing with respect to the particular company, particular business. So all these aspects are helping me to design and implement what is the nature, timing, and extent of audit procedure to address each of the assessed risk at the assertion level, so that the financial statements are not materially misstated, either due to error or due to fraud. So that is where 315 goes or gives a guidance of what is the next step. The design and implementation of responses, or the nature, timing, and extent of audit procedure which we are trying to employ to address the assessed risk as per SA 315. What is the final outcome? The final outcome is to reduce the risk to acceptably low level. What do you mean by acceptably low level? There is no material misstatement in the financial statement as a whole, either due to error or fraud. So the errors, there may be errors, but those errors are less than the material level, then less than the materiality considered in planning and doing the audit. So now you will understand, when we are doing an audit, it is not just sending our team members to go and do the audit, rather than spending more time on planning activity based on the client's business, based on the client business environment, based on the control environment, based on our identification and assessment of the risk of material misstatement, either due to error or fraud, at the financial statement level as well as at the assertion level for each of the financial statement components. Proper audit procedures can be designed and given to our team, so that the team, when they are executing, they will ensure that the risk has been properly addressed, or the risk has been properly responded and reduced to acceptably low level. This is the fundamental, or I can say core principle or foundation for any audit. This is the reason why all the regulators or all the reviewers are normally considering what the auditor has done with respect to risk assessment. Secondly, they have assessed the risk, but they have not responded to the risk. I will give an example. All the examples which I take normally will be based on live cases which either I come across or maybe my friends come across, or which we have seen based on the various scandals, the corporate scandals in India, outside India, etc. But only thing is, the name I normally don't use it because of not get into trouble of saying that it's a information relating to a particular company. We are defaming the company. But without the naming, a lot of lessons are available in the public domain. From that, I am taking one example. When we were talking about the risk assessment is properly done, but responding to the risk assessment is not evidenced in the audit file. Maybe they might have done it, but it's not evidence in the audit file. In one of the audit quality report, which was reviewed on one of the scandals, what they have mentioned was the entire client's business is operating in a computerized environment, system driven, or I should say software driven. Even the revenue accounting is based on software. When you are identifying that revenue itself is being calculated using a software, and your revenue model is brick and mortar model as well as cost plus model. Two models are available. One is for turnkey contract, another is for only normal supply service contract. When this type of complexity is there, the contracts entered into with the client was the most important aspect. And these systems should consider all the relevant parameters required for the recognition of the revenue in the financial statement. So, because its entire thing is computerized environment, I will not be able to just do an audit based on my other audit procedure. I need the help of an information systems auditor, or system process assurance should give me some sort of comfort or some sort of areas where they believe that the application which they are using or the software which they are using has proper controls. Nobody can tamper with that controls. The second is the information technology general controls are proper. They are operating effectively throughout the year. And there is no possibility of somebody going and tamper with the information technology general controls. When this is required for me to proceed further and design my audit procedure, I normally employ an information systems auditor or system process assurance team. The information ISA auditor or information technology auditor, information systems auditor team has done a very detailed work. They have identified areas where the application controls are compromised. Compromised in the sense the application requires a particular level of approval for triggering or maybe originating a particular transaction, but there is a compromise. If it has to go through 10 people, in some areas it is compromised. Even with 1% or 2% involved, the revenue can be recognized. A contract can be created for a customer. So they have identified that there is a flaw in the application control and they have created some sort of red flag. What the audit team is supposed to do, 315 has been done. The material misstatement, assessment of risk of material misstatement has already been done. They have identified. They have also linked it to the financial statement area and the assertion level they have also identified. They have documented and shared with the normal audit team. That's a routine team which will be doing the normal financial statement audit. Unfortunately, that risk assessment done by the system process assurance team has not been given the due importance required. Because due importance is not given, the responses to the assessed risk by means of audit procedure, wherever there is a red flag, there is a possibility of compromise. How I am going to best select a sample to ensure that, yes, there is a compromise, but the compromise has not resulted into an instance. What do you mean by instance and compromise is very simple. Compromise is there is a possibility that somebody may utilize this, right? Instance is somebody has really utilized it and passed a bogus entry, created a bogus customer contract based on which a bogus revenue has been recognized. Let us look at that. So there is a possibility of a compromise, and that compromise has been used by somebody. There is an actual instances. The compromise is identified by the requirement as per the requirements of SA 315, documented very well. But the financial statements audit team has not documented how they have responded or selected samples to ensure that whatever compromise is not actually happened. There is no instances which has happened during the year, even though there is a lapse. So if they have done that, if they have carried out that, then they are in compliance with SA 330. Unfortunately, they have not done. Because they have not done, 315 identified the risk of material misstatement, but 330 procedures have not been complied with. The audit quality report has said that your opinion itself is without any basis. Just imagine, I'm doing an audit for 3 months, 4 months, and the reviewer comes and says that because you have not planned your responses for the asset risk, your audit opinion is baseless. You cannot form an audit opinion. There is no basis by which you can form an audit opinion. Most dangerous, that is the reason why SA 315 and 330 are more critical for our understanding. Right? Now, with this background, let us look at what we are considering as the risk assessment process. What is the risk assessment process which we are supposed to employ in accordance with the SA 315? So that when we document this risk assessment procedures in our planning section and in our execution section, we have responded by means of audit procedure. Of course, in planning section, what is the way in which I am going to respond to the assessed risk will also be documented. And that strategy or audit plan or the nature and timing and extent of the audit procedure will be performed during the execution stage. The exceptions observed will be evaluated whether it is material to the financial statement or not material to the financial statement, based on which you will conclude on your audit opinion as per SA 700, 705 or 706. Okay. What is the risk assessment process which SA 315 is suggesting us to use? It says, first you conduct an inquiry with the management. You remember that we were saying that the 3 words have never changed. Understanding the business never changed. Who runs the business? The management is running the business. When the management is running the business, they don't run the business for the purposes of getting into loss. They wanted to make profit. And when their management is running the business, they don't want it to create some sort of fraudulent financial reporting. They wanted to record proper entries, proper accounting for the purposes of reaching to proper presentation and disclosure of the financial statement. So their intention is only like that. So management runs the business 365 days. The auditor may be spending his time only for a month or 2 or 3, depending upon the nature and size of the client engagement, right? So 365 days, somebody is getting a comfort that there is no risk or there is no key business drivers which I have to worry about, which will result in a material misstatement. So what is the fundamental? Go and ask the management how they are getting the comfort. There is no risk of material misstatement in financial statement. How they are managing the entire business, because they are in that business for 365 days and they are in the business for years together, right? So that forms the foundation of the risk assessment procedure. The inquiry with the management, how they are taking comfort in respect of the risk of material misstatement. Second is when I do the acceptance of the client, or when I do the reappointment process. So normally SQC 1 and SQC 2 quality control standards is saying that at a firm level, what is my policy for accepting a client? What is the risk assessment I am doing that the audit which I am accepting or the engagement which I am accepting has a high level of risk of material misstatement? And if so, what type of expert auditors has to be involved in that particular activity? And how the firm's quality reviews will enable that the risk will be reduced to acceptably low level. So at the client acceptance level, I should collect a lot of information. And it's like your KYC policy, understanding the client. For example, if I'm doing an audit of an entity engaged in jewelry business, the major issue relating to jewelry business is I don't have the capability of valuing the inventory at the year end, whether they are really gold, really diamond, or they are only glass pieces. I don't have the capability. And there is a risk of valuation relating to inventory. And in that particular scenario, what should be my audit response? I should recognize this as a possible risk of material misstatement, maybe due to error or due to intention fraud. Could be a possibility. Because of that scoring pattern which I take, the risk of material misstatement can be up. And I should also decide my NTE of the audit procedure, nature, timing, and extent of audit procedure in such a manner to address that possible risk. So in the acceptance level, I will be doing a lot of background check of the client, business, and the environment, management tone, and is there any accounting policies which they are using, which is creative accounting policy, a lot of things where I will assess. And this is not stopping at the acceptance level. Once I have accepted the client is going to be with me for at least 5 years if it's a company appointment, unless the client is changing or unless I believe that I should give up the client. When I decide that I have to give up the client, it can be possible because in the first year of my risk assessment, I have considered that particular entity is having only a low level of risk. But when I am doing the audit, I have identified that what I have initially assessed is not true. The control environment is not robust. The tone at the top is not robust. The management override of controls is possible. So when I consider that the risk is actually gradually going up, I record all these things in my audit documentation. In the second year, when I am going to continue as an auditor, it is a continuous process. So acceptance is the first year. Second year, I consider the learnings from the previous year audit. What are the material misstatement areas? And apart from that, what is the new development compared to the previous year? Whether any new business line has came in, whether there is any change in the management, whether any change in the key management personnel, whether there is any change in the accounting policy, whether there is any change in accounting estimate. All these things could pose a challenge for my risk assessment level may go up, right? So information which I have obtained during the acceptance of a new client or during the continuance of the existing client, I will use them also as part of my risk assessment process. The third is whatever information which I have taken, I also look at my team members because the team members have actually carried out the work in accordance with their assessment or discussion with the key engagement team. Is there anything additionally we have to consider as the risk assessment compared to what initially we have assessed? Because SA 315 says the risk assessment which you have made is not static. It will go on. It may undergo changes depending upon the audit progress, new understanding of the client's business or new information which is coming up during the course of the audit. So that is another thing which we are looking at. Not only inquiring with the management, we will also inquire with the others. When we are saying others, not to the general public, but the various people in the organization, not necessarily top management, but also functional heads, the owners of various processes. We will inquire and try to understand if there is any risk of material misstatement. We assess that risk also as well. And then I have done the audit of this particular company in the previous year, or I have done some other engagement activity for them. For example, I might have done previously, say, a special management audit for them, and they are approaching us to get appointed as the statutory auditor. because my assignment as a management auditor or as a special consultant has been over. They are now believing that my understanding of their business is good, and they are believing that my relationship is very cordial, and accordingly, I am bringing in value addition to the company. If they are approaching to me to get appointed as auditor, I also use the learnings which I had from the previous engagement. Previous engagement may be my own audit in the previous year, or maybe some other assignment which I have done for the client, based on which I have understood what are all the risks involved in the client's business. Sometimes it may be from the previous audit, previous quarter limited review, significant changes which has happened during the current period. All those things will also be important for my risk assessment process. And then any other assignment which we have done for the entity, from that also we have seen that we will take it up. Another interesting area which we don't do that. This is very recently I have seen in one of the cases where NFRA has issued a notice. They have mentioned that the auditors have not used analytical procedure, or maybe I should use the word, the analytical procedure has not been applied as per SA 520 if I am not wrong. They are saying that you have not applied the analytical procedure, and to that extent, you have not complied with the required standards on auditing. When we were drafting the reply for NFRA, the first question which came to my mind is there any area where you have to apply analytical procedure for this particular client? Analytical procedure is nothing but ratio analysis, trend analysis, or maybe you can say that, say for example, a client is in publication industry, they actually give or actually public issues magazines on a weekly basis. And how I can recognize the revenue? What is the quantum of revenue which has been recognized as proper or not? How I will validate? I can do an analytical procedure. What I have to do is independently I have to find out what is the total quantity sold and what is the normal price which they are giving to the dealers or distributors or the end users, and what is the percentage of discount or commission which they are giving to the distributors and agents. When you reduce that, you'll find out that this is the expected top line or revenue. You set up an expectation, and you also fix up that because you are going with some presumption or assumptions, there is a possibility of plus or minus. So you fix up the precision at which you are looking at this. Say, for example, if I'm considering a 5% plus or 5% minus from my expected number is acceptable to me. So I analyze, set the number, or using that analytical procedure, I finalize what is the expected number and compare that number with the number recognized in the financial statement. If the difference is less than 5% plus or minus, I accept that the entire procedure or the revenue recognized is proper. It is in accordance with standards on auditing. And of course, because revenue is a key risk area, you are supposed to do certain substantive audit procedure also. Other than analytical procedure, you are supposed to do some substantive verification of the transactions as well. But the analytical procedure, when I looked into the particular case where NFRA has issued a show cause notice, the auditor was having a feeling analytical review means I worked out the numbers. Depreciation, I have worked out the number, and I have worked out the calculations and whether they are correct or not. So that are not analytical procedures. They are only arithmetical accuracy which you have ensured. The analytical procedure at the planning stage, the standard says, when I have the current year number and the previous year number based on the initial financial statement given by the management, I see what is the change in the items of the balance sheet, items of the profit and loss account. If the change compared to the previous year is, say, for example, 10%, I believe it's a normal change because in the industry also 10% growth is being seen throughout the industry. And accordingly, 10% plus is acceptable to me. Suppose in revenue, there is a 60% growth, then I will identify that area based on analytical procedure, where there could be a possibility of a risk of material misstatement. And accordingly, I should address what is the reason of having more than 10% variation from the assessed number, from the previous year number. Is there new contracts? If so, whether the new contracts are genuine. If they are genuine, whether the revenue recognition has been done in accordance with the terms of the contract, or there is any problem in identifying the percentage of completion. So all those things which we will be able to do in analytical procedure. Similarly, what is the growth rate year on year for the company? What is for the industry? What is the net profit for percentage for this company? What is the net profit percentage for industry, genuine other companies in the same industry? What is the gross profit margin? All these analytical procedure, including the ratio analysis, can also be brought in analytical procedure at the planning stage, at the execution stage, at the completion stage. You can identify whether the numbers are properly presented or there is a risk of material misstatement involved. That is an important assessment which you can do. But of course, you can also observe the client's business, how it is being carried out, or you can inspect the various documents, contracts, agreements, other minutes, books, etc., etc. You can inspect, including the evidences from third parties, confirmation of balances, etc., based on which you can actually do a risk assessment. So it is like looking at the entire aspects of the financial statement, disaggregated at the components of financial statements at the assertion level. Now you will understand how the linkage between 315 and 330 is coming up. When we are talking about the internal control, which is a foundation for our entire understanding, we are looking at the design, implementation, and maintenance. There could be a design failure for the internal control. Because of that, there is a gap. Design is proper, but implementing the internal control is not properly done. Majority of the cases you might have seen in some of the smaller entities, they might have used ERP system or SAP system, but the way in which they are using ERP or SAP will be like a simple off-the-shelf package. Only debit entry and credit entry are being done. Various controls which are inbuilt in SAP system might have been compromised. Compromised when I am saying through the system, when somebody has to approve it, then only it will move to the next stage. They will remove that particular requirement by unchecking that particular control. So design is proper, but implementation is not effective. Okay, I have implemented that. Everybody has to do that. Everybody has to go through this process, but there are people who are bypassing that process. For that purpose, I have to ensure the operating effectiveness of the controls. So the maintenance of the controls throughout the period under audit is also important. But the problem here which we are having is, depending upon the size of the entity, the design will change, the implementation will change, the issues relating to maintenance and effectiveness, operating effectiveness will also change. I have to consider all as part of my process. That is what we said. Efficiency and effectiveness of the internal controls operating throughout the period is an issue. This is the most dangerous area relating to internal controls. This is where we get into a problem. If this is not properly assessed, there could be a possibility of a material fraud risk is not identified by the auditor. The auditor's audit report is not proper opinion. It contains misstatements, material misstatements, but the auditor, since he has not considered the management override of controls properly, he has assumed that controls are operating effectively, design, implementation, maintenance, everything is proper. On that basis, I can accept the application controls, the information technology, general controls. So I assume that anything coming out of the system is acceptable to me. The problem which we are having, SA 240 is also talking about this very, very clearly. Like 365 days, management is doing the business. If the controls are operating 364 days, on the final day, the CEO or maybe the chairman and managing director of the company comes and meets the CFO and says, I have given an indication of, say, for example, 123.45 crores of EBITDA to the board. I want that to be there. There should not be any deviation from that. So what happens? Whether you have actually done 123.45 crore or not, now the CFO is burdened with the requirement of ensuring that the results is 123.45 crore. How it is possible? Whatever has been done on a routine basis is not an issue, but on a special occasion, I override the controls or I surpass the controls by using some technology or lapses and process entries which will help me to take the desired number or create the desired number. Instead of actual happening, it is being created. So the management override of controls is the biggest issue. If the internal control system is having significant efficiency, this may also happen. So apart from the efficiency and effectiveness, we should also consider, is there any possibility of management override of the internal controls? So that is very important assessment. And another issue which we are having is, say for example, when we are doing a control testing, because majority of the clients which we are talking about in the major level, say for example, it's a listed company. Not only you are giving an audit report for financial statement, but also giving another audit report for the operating effectiveness of your internal financial controls over financial reporting, ICOFR, right? Internal controls over financial reporting, you are giving a comfort by means of a separate audit report. So suppose when I have, because of that, I should test the controls as well. When I do the testing of the controls, what happens? It may be manual control or automated control. Need not necessarily be everything should be automated control. It may be manual controls also. Suppose if certain controls are not operating effectively when I tested, say for example, I have carried out an interim review and I have tested in September and I find that there are some controls which are not operating effectively. So I have asked the management or I have given a report to the management saying that these are all the areas where there is a control lapse. So management is putting a mitigating control that starts from 1st of October to 31st of March. So throughout the year, I'm expecting the control should be operative, where it was operating only for part of the year. So when I identified that this is effective for the part of the year, what should be the risk of the period where it is not effective could pose a challenge of material misstatement. If I believe that there is a possibility, because it should be recognized as a risk of material misstatement. If there is a risk of material misstatement because the controls are operating for part of the year, then I should also go for substantive procedure extensively for addressing that risk. Right? So the moment I have a risk, my common sense will say how I will address that particular risk so that material misstatement will be reduced to that. That is another thing which we have to look at. It may be manual control or automated control, which we have talked about. There are some questions which we are talking about with respect to internal controls. It comes to our mind on a normal basis when we do that work. I try to capture to that extent possible from my own understanding or maybe my own experience over a period of time when I have carried out audit, or when somebody else has came to us for some help in addressing the show cause notice or anything which they have received from the regulators. So what are all those questions? First is, what is the access controls existing with respect to the automated controls, or when you are auditing on a computerized environment? What is the access controls? Whether this access, for example, when I'm having a simple example which I can talk about is that, say, if I'm opening my email, I have to give my username and I have to put my password. Similarly, when an entity is making a payment to a customer, the authorized person should initiate the transaction for payment. It should be three-way matched with the invoice raised, with the purchase order, with the actual goods received. It's all being matched. And after the matching, somebody is approving that all these things have been matched. And depending upon the various levels of authorization, depending upon the monetary levels of authorization, who has to approve that particular transaction for payment? Somebody is approving that according to the control matrix. After that, it goes to the person who is making the payment. And the person having the access to the payment, maybe he will have the access for the net banking of the particular bank, and he approves that particular transaction. Somebody is creating the transaction, but approval at the banking login system is being done by that. Now, payment is made. Starting from the request for payment, validation that yes, the invoice is eligible for payment, approving based on the monetary levels of authorization, initiating the payment transaction, approving the net banking transaction, various levels of controls or various levels of access to a particular transaction has been given. In other words, the access controls are given on a need-based environment. So in this case, the access for the net banking will not be given to any of the person other than the person who has been authorized to initiate, need-based. Suppose if somebody else is asking for that particular control, naturally we will ask, what is the need for it? Why I have to give it to you? What is the role you are playing in that particular activity? So whether the access controls are being given on a need-based basis will give you whether the controls are proper or not. Second is, there is a system or there is a software or there is an application which drives the entire process. Suppose if there is a change in the application or software compared to the previous year, how the change management has been taken place, who has requested for the change and who has authorized for the change, and how that testing environment has been done, and how it has brought into the live environment, how that has been documented and approved, so that unauthorized change to the existing application can be completely removed or brought to the acceptably low level. Second question which we are normally asking. And this operating effectiveness of the control, they will claim that I have a superb control environment. The next question is, have the management tested whether these controls are operating effectively? That's what we have said. Design is there, implementation there, but it's not operating effectively. What is the use of it? So for that purpose, whether the management is testing it on a periodical basis and what type of outcome is arising out of that testing. And it proves that the controls are operating effectively. When it operates effectively, I corroborate with the management testing with my testing and conclude that yes, it's acceptable or not acceptable. This is another interesting factor. Some of the entities are still using this. What they do is, they don't have a complete ERP system. They have an accounting software. They have a separate inventory management system. They have a separate billing system. they have a separate HR system. They have a separate process, year-end process system. Let us assume this. How they have to be connected with the accounting system? After I have generated all the invoices, whether I have to manually key in the invoices, I don't want it to use it. Is there any possibility of pushing all the invoices raised through my invoice system directly to my accounting? Possible. If you create a patch which connects the program relating to accounting with the program relating to invoicing, it patches both. We are able to do the process of converting the transactions or transferring the data very easily. But at the same time, majority of the cases of control compromise has happened over the patches. Patches may not be updated properly, could be one possibility. Intentionally in the patches, I decided that when the data is being transferred, inaccurate data is being transferred or unauthorized transactions is also passed through the patches. And accordingly, the control should not be only tested on the main software, but also on the patches which are being used as part of the entire reporting generated for financial statements. Similarly, we have to always look at what is the level of manual intervention possible. Why this level of manual intervention has to be evaluated, how the management can override the controls, and what could be the possibility of they are using it just like that. So the level of manual intervention will say whether a particular item can be completely relied on based on system generated report or some additional substantive procedure should also be performed. Okay. Now, having seen that, the next important aspect is the control environment. What is the environment it matches? When I say control environment, I am saying that internal controls are put in place, but the environment in which it is operating is not feasible or it is not having the integrity required. In other words, the tone at the top, the management's integrity, whether it is questionable or not questionable. So I have to assess the control environment as well. And in the entire process, how those charged with governance, maybe the board of directors or independent directors or any other overseeing body over and above the board of directors, how they are participating in the review of the entire process of the company's business, and how the management communicates and enforces ethical values to all across the industry, all across the entity, starting from the top level of management, those charged with governance, and up to the lowest level of the employee, how the communication of the ethical values has been done. Because if the tone at the top is not having high level of integrity, naturally the people who are working below will also think that the top management itself is not worried about it. Why should I worry too much about it? They may not have an intention, but they may be having a lethargic way of looking into that, which may create an opportunity for others to commit a fraud. So what is the ethical values which has been communicated, documented, etc. should also be looked into when we are talking about. When we are considering the risk assessment, how we will build the blocks and what is the simplest way of understanding the risk assessment process. I'm trying to give whatever we have discussed so far in a simplest format. One is, what is the business risk associated? This is the reason why we said understanding the business is critical for every audit. What is the business risk? Is it investment risk? Is it inventory risk? Is it revenue risk? Is it non-compliance of laws and regulation? Is it relating to employee risk? Is it relating to fraud risk? Is it relating to selection and application of improper accounting policies? What is a business risk? and what is a credit risk. So all those things could be possibility of fraud risk, business risk, which you have to identify. That's the first block. The second block is, out of this business risk, what are considered to be significant risk? Say, for example, in a IT and ITML services company, I have talked about your revenue could be significant risk, your employee cost could be significant risk, your valuation or impairment testing could be a significant risk. Suppose if the company is making profit year on year, I need not even worry about impairment risk at all. Even though the business risk says that impairment is also possible because of technological changes. But by using the same technology, I am making a year-on-year growth, nothing to worry about it. So significant risk starts with the business risk. Then I further analyze them to see whether they will be considered as a significant risk. When I say significant risk, one rule of thumb which you can use, if this risk is existing, what is the likelihood of occurrence? That is, how many times it will occur, that particular transaction can occur if this risk or control weakness is existing. And what is the magnitude of the impact on the financial statement, considering both? Maybe it happens only one time. I cannot simply ignore that without looking at the magnitude. That one-time effect may be recognizing a gone. So both likelihood as well as the magnitude has to be looked into to assess the significant risk. Yes, after I have identified the significant risk, I have to look at what is the likelihood and what is the impact on that. If there is a likelihood of occurrence, is there any possibility of deciding my responses, avoiding the likelihood of recurrence, putting a control to mitigate that, maybe a preventive control or maybe a detective control. After detecting, I will respond to that assessed risk, maybe by passing a journal entry by means of audit suggestion. You can do that. But preventive is more important than detecting. So preventive, detecting, both has been responded, and accordingly, what is the remedial action? So that is the way in which we have to build the block in our risk assessment process. As you see, the risk at the financial statement level, and then at the assertion level. Assertion level, when we are saying at each of the component, what are all the various promises for each line of or each component of the financial statement. Let us look at the financial statement level, whether the risk relates to a pervasiveness in the financial statement. Pervasiveness means if this risk is not properly mitigated, all the components of the financial statement will have an impact. Pervasiveness. Or it says one single effect will happen, but it will impact the entire financial statements. One occurrence will impact the entire financial statement. The third is transactions have been properly accounted for, but a significant disclosure that the company is going to wind up one of its major profit-making operations or going to demerge one of the activity, which is a material disclosure required for understanding the financial statement. That is missing in the financial statement. So in all these three scenarios, it is considered as pervasive to the financial statement. You may ask, sir, from where you are getting this pervasiveness? If you see SA 705 on modifications in the independent auditor's report, as per SA 705, it says whether it is pervasive to the financial statement, then the auditor may be required to even give a disclaimer of opinion, or maybe has to give a adverse opinion rather than giving a modified opinion. So there are scenarios of pervasiveness. Potentially affect many assertions, not only one, many assertions. Represent circumstances that increase the risk at assertion level. Because of this, the entire assertion may undergo for a change. because of weak control environment it arises. So that is on the financial statement level. On an overall basis, I look into whether this risk will result in such a thing. So that will normally address a possibility of major issues. Now at each component level also I have to see, because I have to address the risk of material misstatement may occur by single transaction or by means of small misstatement. Collectively they are material. Okay. For addressing that, I should go at the assertion level. The assertion level talks about two scenarios. One is the current year, comparative period. Both the periods I have to look at what are all the assertions level. I have talked about all the assertions. Occurrence, that the transactions really occurred. It is not bogus. Completeness, all the transactions relating to the current period has been accounted in the current period. Accuracy, the transactions have been accounted accurately without any mistake. Cutoff, what is the transaction relating to the current period is not going to the next year. What is the transactions of the next year is not accounted in the current year. Cutoff procedure, especially in respect of revenue and expenses. When we also test for unrecorded liability, that is also relating to cutoff. Classification, how the particular asset or liability should be classified, non-current, current, or shareholders' funds. And within the current, what are all the classifications required according to the requirements of Schedule 3? Maybe Division 1 or Division 2 or Division 3, depending upon how the company is engaged. So that is for the current period. For the current period, when I'm saying during the entire year, I should have all this should occur. At the year end, I draw a balance sheet. I draw a profit and loss account. So in that case, existence of an asset, existence of a liability is important. Otherwise, it should not be recorded. Rights and obligations, rights relating to an asset, obligation relating to a liability should be considered. Completeness of all the assets, liabilities, all the transactions have been properly accounted for. Valuation, which we have already discussed, and allocation of these items to various items. For example, even the expenditure which the entity has incurred with respect to overheads might have to be allocated to the cost of inventory, because the company is in manufacturing sector. The cost which has been incurred may be a fixed cost relating to production or variable cost relating to production, how that allocation is also happening. These assertions we have to check, is there any risk of material misstatement? Because the way in which the valuation of inventory is happening is always an issue. For example, in one of the client cases, we have seen that as part of the audit rotation, we have taken up the audit. When we were checking the various accounting policies adopted in the opening balance sheet, as what was audited by the previous auditor, because we have a responsibility to check the opening balances also. When we checked, we looked at the valuation of inventory. The valuation of inventory, the accounting policy says inventory has been valued at lower of cost or net realizable value, whichever is lower of cost or net realizable value. But when we saw the work papers, we have seen the certain numbers, and we try to link that numbers with the cost used by the cost auditor, because the company is also under the cost audit. But there is no relationship, there is no reconciliation. The value adopted for inventory valuation seems to be higher than what is the cost adopted. When we inquired, we understood that for years together, that company was getting the valuation done by the sales team, because the commercial team knows what is the price. But the commercial team knows what is the price. They know only the price of selling. So they have used a selling price. That selling price is used for valuation of inventory, whereas the valuation of inventory should be at lower of cost or net realizable value. So opening inventory has been valued at a higher level. Based on that, we understood at assertion level of valuation of inventory, there is always a possibility of material misstatement. So we have specifically put on processes by which inventory valuation should be linked with the cost allocation, sales figure to arrive at your NRV, and then you should also look at what is the reconciliation with the cost audit records. When we have brought in all these three together, the error has been corrected in the subsequent year, the first year in which we have took up the audit, but opening stock was wrongly accounted for, which has to be go as a error correction. Subsequent year onwards, the client themselves has understood what we are talking about. So that is the way in which you have to look at the assertions level. In presentation and disclosure also, if the material disclosure is missing out, the auditor has to kind of evaluate whether they have to modify the audit opinion as per SA 705. So there also it talks about occurrence of the transaction, completeness of the disclosure, classification, making the disclosure which is understandable, the various disclosures made have been properly and accurately valued. For example, if cash flow statements are being made, the cash flow statement is nothing but disclosure statement, not accounting. But whether the cash flow has been properly drawn up or not, whether certain items to be disclosed has been properly disclosed separately and not as part of the overall change in the working capital movement. Like this, you will go on looking at each and every item of the balance sheet, profit and loss account, disclosure, and look at what is the assertions which should operate throughout the year, at the year end, for the purpose of preservation and disclosure. You will be completely identified the risk assessed. What is the requirement by responding to the assessed risk? Let us assume that this person who is standing here is the auditor. What the auditor is looking for when he is doing the audit, he first look at what is the inherent risk in the business risk which we have talked about. What is the risk which may result in systematic or significant risk of material misstatement? We are looking at what is the inherent risk. So for example, I have talked about a software industry. If I'm talking about a manufacturing industry, what I will consider as the major inherent risk, inventory risk, credit risk, my impairment, my debtors, my sales, my employee cost, my depreciation, my administrative overheads. All these items are, I will consider that there could be a possibility of inherent risk because of the nature in which I do the business. If I'm talking about a real estate transaction, what I will consider as the inherent risk, market value changes, customer expectation changes, market prices are volatile. It's an inherent risk. So accordingly, what is the inventory to be valued and what is the revenue to be accounted for could be a challenge. And in case if I'm taking a business which is retail, I normally consider that the retail business have a more obsolescence issue. Maybe the stock is perishable or the stock undergoes a design change. Stock, the design is not continue to be according to the taste of the customer. So I will identify that inherent risk based on understanding the business and what is the significant thing. Based on that inherent risk, which I have to respond to avoiding the inherent risk, and based on that particular inherent risk being identified, is there any possibility of any material error, probability of material error, likelihood of risk of material misstatement? When I say yes, what I am supposed to do is that I am looking at what is a control environment, control risk, whether the control can filter the inherent risk for all material transaction. That is it caught by control. If I say material error is yes, whether it is caught by control. Suppose if it is not caught by control, what happens is it goes down to the next level by employing my substantive audit procedures, whether it's caught by audit. That is a detection risk. If it is identified by the audit, the risk is reduced to the acceptably low level and financial statements are considered to be not having any material misstatement. So I can issue a clean audit opinion. For some reason, if I say no, it is not caught by audit, I consider that as an audit risk. The audit risk will lead to a wrong audit opinion. This entire risk assessment, one side there is a risk, and the other side how I will respond to the assessed risk, so that I don't want to enter into a scenario of wrong audit opinion being issued. Exactly, the regulator is also looking into this particular framework only. So I'm trying to put a filter, another filter, and even after the filter, I ended up with giving a wrong audit opinion, assuming that there is no material misstatement, but it contains a material misstatement. The brick falls on my head. The regulator blasts me, the regulator is reviewing me, the regulator is issuing show cause notice. I lose my good sleep, I lose my reputation in the society, family, and finally I may end up even having paid the penalty and debarred from my profession. So this is the reason why we have to respond to the assessed risk, right? How to respond to the assessed risk? It's like a balancing activity. Balancing activity, when I say I cannot do over audit, but at the same time I cannot do an under audit. If I do an over audit, the problem is my cost will go up. I will not be able to meet the timeline. If I do the under audit, the risk of material misstatement in the financial statement is high, whereas I conclude that nothing is there in the financial statement as a material misstatement. Okay, that is the worry which I am having. So how I will respond? First, I will understand what is the environment in which entity operates. What is the nature of the entity? Maybe what is the operation they are having? What is the governance framework? Who is owning it? Proprietor or one particular promoters group with very strong shareholding or thin management promoter level holding, shares are spread over a period of time. What is the structure? Whether it is a private limited company or public company or 1% company or anything else, and what is the source of financing? Is it only through capital or heavily borrowed funds? If heavily borrowed funds, what are the risks associated to that? And what type of investment the entity has made? Maybe the entity's business is very good, but the investments it has made in the other entities is not yielding good revenue, and even the original investment may be impaired. So we assess, when we respond, we will identify based on nature of entity what should be my audit procedures. What is the objective for which the entity has been established? What is a business risk which may lead to material misstatement? So that comes to my mind. And how the management gets the comfort, I analyze this and then use it for the purposes of putting additional audit procedures. And then what is the accounting policy which they have adopted? Maybe the accounting policy, whether properly selected, whether properly applied for, whether they have been relevant for the particular client's scenario, and whether they are consistently being followed up according to the financial reporting framework, or there are innovative or creative accounting policies being adopted. The moment you are deviating from the generally accepted accounting principles, automatically there could be a possibility of risk of material mistake, maybe due to error or fraud also. So accounting policies is another issue. And what is the performance of the entity as such during the year and the past? How it is being reviewed by the owners, reviewed by the people who are charged with governance. And this performance, when the performance levels are not according to budgets, in fact, auditors are also supposed to look at budgeted versus actuals to see whether there is any material deviance from the budget. Very high deviation on the upper side or lower side, both will show that there could be a possible management override of control. Like, then comes what is the industry? What is the regulatory framework? What is the external factors which the entity has to address because of the environment in which it operates? So whether that industry level or regulatory level or external factors pose any risk whether I have considered the mitigating auditing procedures to respond to that assessed risk. Understanding the laws and regulations could be one of the area, and based on which what is the audit procedure I am performing could be another way of responding by SA 330. When we are doing this, responding to the asset risk, again, a summarized way of understanding this is top-down risk-based approach. Meaning is, what is the significant risk which may result in material misstatement, and what is the next level of significant risk. So I put up, if this particular risk is existing, that could be a material misstatement. I identify that items and then putting them in a top-down risk-based approach, based on which I am identifying the key business drivers. If this is missing, the business will derail. Identify that, and using that assessed key business driver, I also assess and evaluate the likelihood of risk of material misstatement, either due to fraud or due to error. Both I will evaluate. After having evaluated the risk of material misstatement, what I do is I map the assessed risk at the assertion level. You have already seen that in the overall framework. Once I have mapped the assessed risk, I will design the nature, timing, and extent of the audit procedure which I am supposed to perform. I will execute, and based on that, I will identify what is the various misstatements during the course of the audit, and that misstatement has to be evaluated whether it on an individual basis or on an aggregated basis gives a risk of material misstatement, and based on which I execute the entire work, complete my assessment, and decide whether the financial statement has a material misstatement or not. In other words, by means of the top-down risk-based approach and linking every risk up to the assertion level, designing proper audit procedure accordingly, executing them and completing them, I will be able to respond to the assessed risk in accordance with SA 330. There are some special considerations which we should also look at, because just looking at the control environment or just looking at the substantive audit procedure, you may omit certain possibilities, and I am trying to take those items. Both SA 315, when you are assessing the risk of material misstatement, and SA 330 very strongly recommend that the auditor should always apply professional skepticism. Meaning what? You should always have a questioning mind. You cannot accept anything just like that. It is not like investigation, but when something is given, you are trying to apply your experience, your knowledge, your understanding of the client's business, and then try to see that the evidence which you have collected is appropriate in the relevant circumstances, and that evidence is not tampered evidence. So you apply your professional skepticism. What is the level up to which you can rely on the management's response, or what is the level at which you have to corroborate the management response with the audit approach? In another case where there was a question by MCA, where they have sent a show cause notice, why can't we refer your case to the disciplinary committee of the institute? The MCA has actually mentioned that in respect of certain transactions entered into with a related party, the auditor has never used his professional skepticism and considered them as arising during the normal course of business. Whereas that one-off event or one-off transaction has inflated the profits to such a high level, whereas it is no actual occurrence of the transaction has happened, and it is not existing. It is a bogus transaction. So the professional skepticism is always a point of judgment, but at the same time, I expect that without professional skepticism and knowledge, we will not be able to do any audit. We will definitely have this. Unfortunately, documenting the professional skepticism, how we have applied that, we are not proper. We are not robust in documenting. So please follow what is given in 315 and 330 with respect to professional skepticism, then you will be on. This is another important aspect which we have already discussed. Even though we are talking about responding to the assessed risk, your risk assessment should always have a fraud risk also as part of your risk assessment. And accordingly, when you are assessing the fraud risk, you will always consider if there is any management override of control. That means management will come and surpass all the existing controls and say that pass one journal entry, finish, and reach what is the desired number. I still remember that in one of the audit acceptance first meeting when we went for making a presentation, the CFO has told us, sir, we have a very open discussion with the auditors, and we also want your guidance wherever we have an issue. So we said, yes, 100% it is possible, because we are not here to find fault, but we are trying to find out a solution within the four walls of law. Then the CFO has said, we normally have a practice of discussing the significant development during the quarter, and we will ask you how we can go ahead with that. That significant development during the quarter, when he has listed out, he said, this period, I don't have good sales. So it is a significant development. Naturally, you expect that their profit compared to the previous quarter will be low. But he said, even though my sales have come down, I have already committed to my investors and borrowers that this is my EBITDA. So I want the EBITDA to be there. Please give a solution for it. One moment I was taken back. I said, sir, I don't think that audit is using an Excel spreadsheet where there is a debit side, you find out a credit side. That is not the way. I am trying to find out a solution. Suppose, for example, a particular transaction, how it has to be accounted for, and you have a different view and I have a different view. Let us sit together, discuss, and find the solution. What is the best way in which regulators and the act is looking for? That is what. So the fraud risk and management override of control, the moment we have had this, similarly come out with some 2-3 points, and we have said, sir, according to our risk assessment procedure, it is not your client acceptance is becoming very high risk, and our risk management team is not accepting to give a go ahead for accepting your audit. So you have to be careful, because management override of control, one single point of agenda will result in a completely different picture for the financial statement. But that doesn't mean that every management will be looking only like that. So the standard says you should also factor the possibility of fraud risk, also factor the possibility of management override of controls. And based on this two risk assessment, what is your response for that two risk assessment? If you are not properly documenting how you have considered, it is really very difficult. In fact, I used to say all the non-standard journal entries has to be downloaded and verified in full. Now data analytics is available, so you need not even go for sampling. You can do a complete analysis by putting up your own queries. If this are existing, this journal entry is considered as a non-standard journal entry. And if you believe that the non-standard journal entries have been filtered separately and this is actually seems to be a management override of control, you can identify them very easily. So you have to look at that special consideration. What is the recent development in the economy? Recent development in the accounting, both are very important. For example, when we were sitting in one audit committee, when we were making a presentation, one of the audit committee member, a director, independent director, has just like that asked a question. What is your expectation of the war between Russia and Ukraine on our industry or on our company? If I have just prepared my mind only for the audit of the financial statement, I may be losing an important aspect. Fortunately, we make our internal assessment as soon as the economic development has happened. We are trying to find out what this will impact a particular industry, and if that industry in which our clients are operating, whether it will impact them also. We make a little bit of assessment, and that assessment is documented in our general understanding for the entire team, office as a whole. And the office as a whole will take this when they are going for planning the current year audit or meeting the audit committee for when presenting the previous quarter's report. Because we are very clear on the impact assessment, we have told that this is what we expect. And immediately the next question came was, do you believe that the risk of misstatement will happen in the financial statement also? Yes, on certain areas, impairment may not have been done. Like that, we have started explaining. Similarly, when the accounting developments are changing, for example, lease accounting has came in Ind AS 116. Some of the companies where they have applied some transitional approach on a partial basis made certain mistakes as well. Government grant accounting. Everybody has felt that our Ind AS 20 and IAS 20 are in similar terms. And when there is an amendment which has happened in IAS 20, we have also adopted that here. For example, where you have received a subsidy in respect of specific asset, previously the method was setting up a deferred revenue and then recognizing it. But before the first level of implementation of Ind AS came in, we have also changed that, second level of implementation, second phase of the Ind AS implementation. They have amended saying that it can be adjusted against the carrying amount of the asset itself, like what we were adopting in our AS 12. So they have brought in that if I'm not keeping on updating what is the accounting development, I may miss out. That is a special consideration for material misstatement. And I should respond to this assessed risk. I should have a proper policy or an audit procedure to address this. Accounting policy is complex, transaction is complex, special focus should be given to that for the purpose of determining whether there is a material risk of material misstatement. And if so, what should be the way in which, whether I have to employ some experts for the purpose of this. For example, there is a derivative accounting they have accounted for, or there is a securitization transaction they have accounted for, which brings on a one-time profit of so much of crores. Necessarily, if I'm not having the capability to understand that, I should use my partner who is very good in financial instruments, right? That is the way in which you have to respond yourself. Related party transactions, always a special focus area. All the audit quality review statements by NAFRA concentrates on fraud arising through related party transaction. You have not identified the related parties. That is what they are mentioning. How you have identified the related party is not documented in your audit documentation as per SA 230. So identification of related party, their relationship and the transaction with them, whether they have properly presented and disclosed in accordance with the applicable accounting and financial reporting framework, all those things are a special consideration for risk assessment and responding to the assessed risk. Areas where there are a lot of judgments involved, subjectivity involved, you should be very careful. For example, if I am talking about warranty provisions or any other items, I should be very careful in doing that particular area. If any transaction are happening in the normal course of business, I need not worry. Anything arising outside the normal course of business, you should focus those areas and you have to respond to the assessed risk according to that. Test of controls, you can, part of the control testing you will normally do, for your ICOFER testing you will normally do. So all those things which we have talking about the automated controls, controls at the assertions level, all those things we have already discussed in depth. Substantive procedure, what is the nature, timing and extent of audit procedure for each material class of the transaction or each material account balances, each material disclosure, And what is the result of test of control, which may ask me to go further on substantive procedure? What is the risk and assertions which I have to address, based on which whether I have to expand my substantive audit procedure? All those things are very important considerations when we are talking about SA 330, responding to that. And nature, timing, and extent of audit procedures is very important. Very balancing act. What is the previous audit period? What are we learning from that previous audit period? What is the coverage which we have done at the interim audit, and what we are going to do at the year-end audit? Or we are going to use roll forward, roll backward techniques? What is the latest development? Have I factored them? What is my result of analytical procedure? You remember that I talked about the analytical procedure at the planning stage itself. If there is a significant variation between the last year number and current year number, what I have assessed, and whether there is a variation which has to be deep dived into. So that I use, when I use a sampling technique, what type of sampling technique is good to address the material misstatement, how the aggregation risk can be addressed. All those things should also be balanced when I use. There are some special areas where I have to use the technique for responding to the assessed risk, external confirmation from the third parties, control over the process of external confirmation. We had a separate session before on 505. I have done one program for WASP. You can look at the recorded where the control over initiation, receiving, and evaluating the external confirmation we have discussed at length. SA 505, the application guidance, will give you a lot of help on this. Key reconciliations which you wanted to do between GST with the turnover as per books of accounts could be one key reconciliation which you are looking for. The TDS versus the income recognized could be another way of key reconciliation which you are looking for. Bank reconciliation statements are key reconciliation. Statement of accounts received from major customers and tallied with the balances or reconciling items in that, how you are valuing. The reconciliation between the parent company and the subsidiary company, the reconciliation between one unit to another unit, intercompany or inter-branch transactions covered under the overall trial balance line item. All those things could be another area to respond it. Roll forward, roll backward, we have discussed. Another interesting factor the standard talks about is the auditor should always think about bringing in an unpredictability of his audit procedure in doing it. For example, you know that you are an auditor, you are going and doing the audit only for a month's time. Whereas the management also employs professionals who are also senior chartered accountants, senior accounting professionals. They also know what will be the normal way in which you decide your nature, timing, and extent of audit, and based on which they will also keep those items proper. You will not be able to identify any exception, even though there are any exceptions possible. Accordingly, when you do audit, what you are going to do, certain unpredictability should also be there. For example, they are saying, normally the auditor will look at only the major items, top 10 items, top 15 items, or top 20 items. And in that process, smaller items will be used for doing the adjustment. Let us assume that they are using it for doing the adjustment. You will not be able to find out. But your unpredictability can talk about top 20 items. Apart from that, this year, out of these 3 months, we will also take certain smaller items for verification. Unpredictability. I have verified or joined for stock verification, inventory verification, only for the godowns which are having higher stock. But this year I also use certain warehouses where the stocks are very low to ensure that there is no stock which has been hidden there, where they are showing that has already sold, but they are posted them as they have dumped them there because it's not reached the client's place. Could be another predictability which I can talk about. The confirmation of balances, they will know you will only select top customers and send the confirmation of balances to them. I will also select certain customers who are having zero balances and send it. And predictability. So this type of unpredictability will reduce the possibility of material misstatement further down. You are responding to the assessed risk of fraud in a different state and ensure that everything comes properly. And of course, whatever you are doing, what the communication you are having with the client should always be better, because sometimes client may not be intentionally doing certain things, maybe because of ignorance they will be doing, and they know how to run the business. When you are going and talking to the client, you will know better ways of addressing the risk of material misstatement or responding to the assessed risk. So communicating continuously with the client throughout the audit is very important. And the risk assessment also says that originally you have made a risk assessment, but the actual audit evidence you have collected shows that your original risk assessment is not correct. There is an inconsistency. In that case, you should also ready to revise your risk assessment as per 315 and changing your audit procedure to address the assessed risk based on the revision. Okay, that's what they are saying. Based on new information or maybe based on evidence from further audit procedure, there is an inconsistency with the original audit evidence. Then you revise your assessment and modify your planned audit procedure to mitigate the possibility of risk. To summarize, I can say the risk of material misstatement is what we are trying to identify as per SA 315, and we are trying to address this by 330 by putting in the nature, timing, and extent of audit procedure, addressing the risk of material misstatement at assertions level and putting in audit procedure there, considering the areas susceptible for fraud risk also as risk of material misstatement, test of controls at assertions level, carrying out substantive audit procedures, including external confirmations, etc., we will be able to bring out the application of 315 properly, how we have assessed, and how we have responded as per SA 330. The most crucial point is documenting them also as part of our process. Because if the audit documentation is not there, you know pretty well the regulators are considering that you have not carried out any audit work. So I think that brings me to the end of my session. I will be happy to take any questions for the next 5 minutes. And if the contact details which you wanted to have is available with the WSP and also in the slides. This slide deck I will share with the WSP and they will be putting in the WSP for using it in your for your reference at a later point of time. So I stop sharing, but any questions if you have, I will be happy to take those questions.
Thank you so much, sir, for such a detailed and wonderful deliberation on both these standards. So I have received 2-3 questions. First question is, what are the general tools used for assessing risk environment for the client, and how much reliance such auditor can put on the risk assessment made by second or third lines of defense?
Okay. The fundamental principles which we are talking about risk assessment, the client is actually using certain models. That models which talk about your control environment, your review of controls, monitoring of controls, all these things, IT communications, etc. This is a model used throughout the world as a generally accepted principle. Because the model was already available and it is well known to all of us, we will also be able to assess whether the assessment made by the management is properly done or not. At SA 315 and 330, both of the standards are giving. The first part is actually the standard, and second part is actually your application controls, application guidance, AG, application guidance. The application guidance gives a lot of illustrations, a lot of examples, how you are supposed to look at. I think that if you are doing it, you will be addressing these two issues. Yes, sir. Next question. Aniji, you are on mute. Is there any other questions which we are having?
Sir, can you hear me?
Now I am able to hear you.
Yes, sir. So question is, operating effectiveness tested periodically. Management hardly goes into the aspects in the practice, issue demanding and circumstances prevailing. Responsibility falls more into the auditors for ascertaining its effectiveness for the purpose of reliable reporting. So can you put some light or your comments on this, please?
See, existence of a control is not enough. The control should be operating effectively means whatever I have planned as a control, if a particular transaction goes into that process should test all the controls which I have put in. And if that test has been properly done and it passes through that test of all the required controls being pass, then I say that the control is operating effectively. Let us take a simple example. See, for example, if an inventory has to be purchased, I say that the first control should be a valid request for the inventory should come from the stores department or maybe the floor or factory. Let me look at. When it comes to that, the stores department should check whether the inventory of that particular item already existing beyond that minimum order level or whatever. If it is already existing, they have to reject passing the request for a purchase order and say it is already available. I am issuing from my stores itself. No purchase is required. Suppose if it is lesser than the limit which is existing, what they will do is they will recommend for this to the purchase committee. The purchase committee will have a standardized list of vendors. Normally that is happening now. It is not happening like they will call for tenders, sit for 3 comparative reports, etc. Nowadays, because just-in-time inventory is being maintained, they have the standardized or maybe approved vendor list, which has been evaluated well in advance and for quality, rate, supply terms, etc., they do that. And out of that, to whom I have to place the order. So when I am placing the order, selection of that particular vendor for this order, what is the basis? Whether it has been approved based on the control placed. Okay, that has been placed. And what is the amount of order I am placing for that particular customer? Whether it requires that it should be split between 2 customers to ensure that in the event of non-supply by that, my production should not get affected. Whether I am splitting that. And if so, who is taking that call? What is the monetary levels of authority they have to approve this purchase order? And when the purchase order goes out, material has been coming in. Who is receiving that material? What is the controls over that? Who is doing the quality check? And what is the controls over taking them as part of inventory? From there, what is the issue which is happening? What is a line rejection during the process? And what is a quality rejection? Whether the material should be debited back to the supplier or the payment can be passed. If you see this entire cycle, everywhere I am saying that there is a control. If suppose a particular control is not operating, I am finding out what is a particular control which is key. For example, let us assume that when I place an order, it should go to an approved vendor. But I am selecting a different vendor and passing it because the different vendor can get me some sort of special benefit to the person who is passing the order. So if that type of mismatch is happening, immediately it should be detected. That is what operating effectively. The auditor should go and check the various processes, controls, and to select some samples based on whether it's operating daily, weekly, fortnightly, monthly, or yearly, and to decide the samples and do a walkthrough of the entire transaction. And if he found out, then that exception should lead to that the operating effectiveness is not fully available. So that is the way in which you have to look at. And this operating effectiveness is expected to be there throughout the year. That is the most important point. Sometimes the control might be failing in the first quarter. They have rectified in the subsequent quarter. That is the reason why in one of the slide I have explained, for the period where it is not operating, have you done your substantive audit procedure? Have you documented that? So that could be the better approach to give a clarity on your question.
Yes, sir. So do we, as auditors, need to assess business model or business manuals of the clients?
Business model and business manual.
Yes, sir.
Okay.
Business model or business manual of the clients?
Okay. See, actually, understanding the client's business will normally happen by doing a research on the particular type of business. But sometimes certain clients' business will be very unique. In that case, sitting with the client, inquiring with them will be the only way in which we can do that. And when we are doing this, we need a corroborative evidence of what they are saying, for which we can actually look at what is their business model and what is the business module. But only challenge which I am seeing here is sometimes clients will hesitate to share that information, saying that it's confidential to the client's business, and anything which is leaked, their business will be impacted. So creating a trust with the client that the confidentiality will never be crossed by the auditor, and it will be maintained throughout the audit, and even after that, you have to create some sort of trust. In that case, looking at that will be helpful. But if the client refuses to give that manual as a right, you cannot claim it. Because if they believe that it's confidential to their business, it is very difficult for you to get that information. But only thing is, can you do your assessment of the business and the risk with an alternative procedure? You have to employ that. Only if the alternative procedure is not at all possible, it may go for a scope limitation. If it goes for a scope limitation, you have to tell the client, without understanding these items, it is very difficult for me to do an audit, and accordingly, my opinion cannot be properly backed up with sufficient appropriate audit evidence. In those scenarios, the expectation is I should not accept the assignment. I will be withdrawing from the assignment. And the client will understand. Normally, I never had a scenario of client doesn't wanted to explain their business model, share this business model. Only one case in my entire life has come out as one of the scenario, because the client was developing a particular technical know-how, and the technical know-how they don't wanted to explain. But when we have asked them to understand the business model, they have said, this is the model which we are creating on an overall basis, but this is the revenue streams which we are trying to come out. And these are all the downside of this, flip side of this. That is, if the technology is not going up, these are all the things which will happen. So that is enough for me to assess the risk. So it need not necessarily to jump to the conclusion that it's a scope limitation, but we can create trust to get that information. But you don't have a right to look into that. You can ask the client to give it. If the client refuses, you have to perform alternative procedures.
Yes, sir. Thank you so much, sir. Now we have come to an end.
Thank
you have justified with your presentation and various answers also, sir. So on behalf of AASB of ICAI, I extend my heartiest thanks towards you for sparing your valuable time and acceding to our request on a very shorter notice. And you have covered everything, every aspect relating to both these standards. So once again, thank you so much, sir, for your sparing your valuable time and enlighten all of us.
Thank you, as well as the chairman, vice chairman, convey my regards to chairman of AASB.
Yes, sir.
Singhal, a very long-term friend of mine,
yes,
and also a very strong technical person. Yes, I enjoyed being with you as well as Sanjeev. And thank you so much. And for the participants also, thank you so much for your patience here.
Thank you. Thank you so much, sir. Namaste.